Afternoon, everyone. So we'll move to the next chapter, which is majorly to understand the infrastructure and the overall mechanism of order flow and how the trading happens in this interest rate derivatives market. So the key components of the trading infrastructure are the participants. This could be the client, the broker, the clearing members, and other participants. The exchange systems, that is how the exchanges are equipped, what technology is used, how the market data is provided, how the orders are managed as part of the order management lifecycle. So this exchange and order management are interlinked. Order management is done on the exchange. So there are algorithms for order matching, order placement, order cancellation. So we'll see all of those in detail in the subsequent slides. And the most important is the risk controls, because these are live trading. This is actual money that is getting exchanged on the uh, exchange platforms. So they have to protect the buyers and the sellers, and at the same time they also have to make sure that the settlement is honored. So there is a lot of risk controls that are in place. So we'll see all of these components in detail. So what are the entities in trading systems? One is the trading members. Now these are basically brokers. These are brokers who will facilitate the transactions. Then there are clearing members. As I mentioned, there are central clearing parties. They will maintain the accounts of both buyer and the seller, and whoever is obligated to pay the other person, all the records will be maintained by the clearing members. They ensure proper settlement of obligations arising from trading activities. So the first entity is the trading members, which is essentially brokers. They can trade in their own account, which is the broker's own account, or on behalf of the clients, like we do, right? If we want to trade into any stock or any bond, we can log into portals like Zero, the ICICI, Angel One, or some other portal, and we can trade in that app or in that you know entity. Similarly, the brokers themselves can trade in their own account as part of the uh, trading member account. So these are the trading members, which are brokers. Clearing members are central clearing parties. And then there are end customers who are like us, end users, who are logging into these portals and buying and selling the bonds and the equities and derivatives, right? It could be a retail, public like us, or it could be corporates or banks. Basically, the end customer who is actually doing the purchase and sale of the underlying contracts. So under trading member category, so trading member, again, remember trading member means broker. So broker can trade in two accounts. One is a client trading. I can call up my broker and tell him that buy 1 month bond future for me. So what the broker will do is, against my client code, he will purchase a contract. Similarly, the broker wants to do trading of his own money, That's why the word proprietary trading. Of his own money, he wants to do some trading, he can do the same. Over here, it's written proprietary trades must maintain adequate capital and comply with position limits set by the exchange. See, the position limit will be for both client and the trading members also. But for the client, the position limit will be as per the client's own capacity, right? A client might not be that big, or it might be, if it's a non-individual, it might be a big entity. Otherwise, most of the clients will be retail clients, or small time corporates, or institutes or something like that. But the broker themselves have a lot of money. They can trade in their own account, which is known as the prop trading. It's known as the prop desk. You must have heard of this word, the prop desk. Prop desk is trading in their own money. When they're trading in their own money, they are liable to maintain the limits that are set by the exchange. So there are a lot of limits that are set by the exchange. There is open position limit, then there is a total turnover limit, all those things. So there are a lot of limits which are maintained. So the broker has to make sure that he is adhering to these kind of limits. What is the architecture of the exchange trading system? First is the order entry. The first place is the order entry. Trading members submit orders through dedicated terminals connected to the exchange central matching engine via secure communication network. So let's understand what it is. It is like this. It is the trading members portal. It's a trade portal. Then this is the exchange, the data exchange. This is the exchange OMS, order management system. So the trades go into this terminal. Once the orders are confirmed, the information goes back from the terminal to the trading portal. And this is done over a secure network. That's what written over here. It's done over secured communication network. So these are very high frequency and low latency data. So that is why a good technology infrastructure is required to do the online transactions. Second is the order matching. What is order matching? Order matching is, suppose I bought 400 lots at say 101, and here are the sellers, and sellers are like this: 200 at the rate 101, 150 at the rate 101, then 50 at the rate 101. So to fulfill 400 buy orders, 3 sell orders have to come in because the total should match 400 over here and 400 over here. So all this order matching is done by the order matching engine. It could be on price priority, or it could be on other mechanisms that you will see in detail. But for now, just understand order matching is basically it will try to match the price and the quantity with the seller and vice versa. Trade confirmation, as I mentioned here, TC, trade confirmation, any orders which are executed over here and which are successfully fulfilled will come back as a trade confirmation to the broker. Executed trades are immediately confirmed to both parties with details transmitted to CCP. So understand like this, this is the end user or the broker. This is the exchange platform. Once a confirmation comes, it goes to the broker as well as it goes to the central clearing party, because this guy needs to know who is the buyer, who is the seller, and what is the obligation that is pending across both the parties. So now what are the key features of a trading system? First is the anonymous trading. Whenever there are buyers and sellers, they don't know who is buying and selling. Obviously, when there is a market acquisition which is happening, then the information comes. If it's a very bulk deal, or say it's a sizable percentage of uh, the company or the lot being purchased. Otherwise, for normal trades, the information is not revealed who is the buyer or the seller. Only for strategic or large acquisitions, the company might, or the exchange might declare that who was the buyer and who are the seller, especially for the bulk data. Real-time processing, obviously, whenever there is a transaction which is happening, a buyer and a seller, the real-time prices are quoted based on the demand and supply in the market, based on demand and supply in the market. So if a purchase order is placed, it will be placed higher above the previous order if there is a lot of demand. Say suppose the previous order was executed at 101.05 and there is still demand for this bond, future, or for this asset, the next price would be above 101.05 because the demand is above the bid price. In trading, always remember bid means the buyer willing to pay, the price that the buyer is willing to pay, and ask is the price seller wants. So bid ask, you will see a lot of time what is bid, what is ask. So bid is the buyer, ask is the seller. Transparent market data, the system disseminates comprehensive market information including bid, offer, price. Again, bid is buyer, ask or offer means seller. Order book depth. What is order book? The buyers will have all their buy orders over here. The seller will have all these sell orders over here. So this is your order book. How many orders are pending to be executed? Audit trail means all the transactions that are happening. Suppose I bought 101.05 200 lots at 11:04 a.m. All these transactions get time stamped, date stamped, and they are maintained as part of the records. So if you see your contract note which your broker sends you, it will have the exact time in seconds when your order was placed, what time it got filled, and at what price it got filled, what is the unexecuted order, and all those things. So everything is maintained as part of the audit trail. Good afternoon, everyone. Trail. So 10,000 shares. And what is the OMS life cycle? What is the order management life cycle? When was it placed till the end? When it's executed and fulfilled? So the order placement, when you're placing an order, you need to put certain details like what is the contract, quantity size, price, and the order type, like buy 4 lots at 101.05 market order. So this is the information required in the order placement. That's the first stage. Second stage is pre-trade validation. Now this is very important. The system validates order against risk limits. Now, which is the system? This is the exchange system. Margin availability, position limits, and regulatory requirements before acceptance. Now suppose I am buying an interest rate futures and in my margin account I have say 80% of what is the actual margin required. So whenever I place this order, the system will prompt me that your shortfall of your margin before executing the order, please post more margin or put more cash in your margin account. Then only you will be able to proceed with the order. So these are the pre-trade validation. Before the order is actually executed, there is a lot of compliance and validation check. Third is the order matching. Order matching is basically whatever the buyer has posted versus whatever the seller is asking. Whenever they match, the orders are automatically matched, auto-matched. And finally is the trade execution. Trade execution means these orders, when they get matched, they actually get executed. Once it's executed, the order becomes a trade because till now it is not a trade, it's just an order. But once it's executed, it becomes a trade. Now this trade information as to what is the actual purchase price goes back to the buyer, the seller, and the CCP, the central clearing party. Why? Because the central clearing party is liable to clear the cash and the security for both buyer and seller. So whenever an order gets executed, it becomes a trade, and the trade information comes back to the trade confirmation comes back to the buyer, the seller, and the central clearing party. Now, what are the different order types? First is the limit orders. So as the name suggests, limit. Limit means it will execute only if the exact price matches. Or if it's favorable. So let's take an example. I want to buy a bond futures at 101.04 and I'm not ready to buy anything above this. Anything above this, I am not ready to buy. Anything at this price and below this price is what is my intention. So this becomes my limit. What is my limit? My limit is 101.04. Hence the limit order. So whenever I'm buying, I would want to buy at a cheaper rate. So 101.04 or less than that is okay. The order will get executed. If the price is more than 101.04, it will not get executed. Why? Because this has been punched as a limit order. Any unexecuted transactions remains in the order book until it is manually cancelled. So that's the limit order. Limit means there is a limit that you have set. You will buy at that price or below that because you are a buyer. Similarly for seller on the other side. Second is the market orders. As the word suggests, market means current. Market means whatever is the current price. Orders to buy or sell immediately. Immediately means current price at the best available price in the market. Now, why will you do this? See, this will happen in terms when you want immediate liquidity. Immediately you want to sell and get out. That time you'll place market orders. Or suppose you want to buy an asset and you want to buy it as quick as possible. As quick as possible. Whenever you want to buy as quick as possible, will you put a limit order? You will not put a limit order because limit order will wait for the price to come. But when you put a market order, the order will automatically execute on whatever is the current price of the market. So that's why when you use a market order. Last is a stop loss order. Again, as the word suggests, stop the loss. Now, suppose I bought something at 101.04 and I want to sell it if it goes below 101. So 101 becomes my stop loss order price. As and when the price goes to 101 or below this, an auto sell order is triggered. Auto sell order is triggered, and that helps to maintain the or lower the losses, because now I have a stop loss order which will allow me to exit the position in case it goes on the downside. Now, in continuation, we'll see what are the order attributes and conditions. Time validity, day order, GTC, IOC. So day order means it is valid only for the trading day. Suppose I have put an order today on 27th Feb. As soon as the end of day comes, this order will get automatically cancelled. So this is valid only for today. Very simple to understand. GTC means it will remain active until it is executed or cancelled by the trader. That means if I put an order on 27th, say I want to buy 101.04, a bond future, if the price reaches this actual price, it will get executed, or it will remain in my order book until I actually go and cancel it. So as the name suggests, this validity is day order. This will be valid until I actually cancel it. So that will be good till cancel. This is IOC, immediate or cancel. Must be executed immediately in full or partial quantity, with any unfilled portion automatically cancelled. That means if I put an order of 101.04 at the rate 400 quantity, and if the price matches this one, it will get executed. Suppose out of 400 only 360 got purchased and then the price moved to 101.08. So remaining 40 will not be executed. This remaining 40 will be cancelled. Why? Because this is immediate or cancel. So whatever gets filled immediately, the remaining should get cancelled. So 360 got matched with 101.04, it will get matched, and then 40 something which will not get matched, so it will get cleared. This was time condition. Now we'll see the quantity conditions. AON is all or none. Taking the same example, we placed an order of 100 at 101.04 for 400 quantity. Now all or none means if out of 400, say only 350 are getting executed, this will not be accepted. Why? It is saying either execute all or don't execute at all. So either 400 exact will get executed or none of them will be getting executed. Then is the FOK, fill or kill. It is a combination of IOC and ON, must be executed immediately, otherwise cancelled entirely. Again, as I mentioned, in AON, it will not execute until all the quantities are filled. In FOK, it will be AON plus IOC. If it is getting executed immediately, it's okay. Otherwise, it will automatically get cancelled. Then there is a minimum fill. It specifies minimum quantity that must be executed with remainder subject to normal matching rules. Last is the disclosure options. Disclosed quantity, only a portion of total order book is visible in the order book, helping large traders minimize market impact. I'll show you what happens when you place an order. So there are multiple fields. Say, let's say I want to execute and I want to exit a position. And I have, say, suppose 10,000 shares or 10,000 units. So these are my actual units. But to show the order book of 10,000, if I come and sell 10,000 immediately, people will think that the bond or the underlying asset is not favorable and there are people who want to sell it. So there is one more quantity, one more field given by the exchange, which is the disclosed quantity. How much I want to disclose from this. So suppose I want to sell 10,000, but I will disclose that I want to sell only 1,000. So in the order book, it will come as 1,000, but behind it will be actually 10,000 shares. So this is basically to hide your large trade. Second is hidden orders. Entire order quantity concealed from market view until participating in the matching process. This is a type of orders. Then this is iceberg orders. Large orders split into smaller visible portions that replenish automatically as executed. What is an iceberg? You know that iceberg is basically only 20% above the sea and the rest of the portion is below the sea. So an iceberg order means large orders are split into multiple orders and that replenish automatically as executed. That means I want to execute 10,000 shares or 10,000 quantity. I can create 10 different orders of 1,000 quantity and execute the transaction. Prevent concentration of positions that could impact market liquidity. Now we'll see the price matching algorithm, price and time priority. Price priority, orders with better prices receive priority, buy orders with higher prices and sell orders with lower prices are matched first. Now suppose I want to buy a share or an asset, suppose asset whose current price is 105. I'll put two orders. I'll put one order at 106 and the other order at 104.5. This is the current market price and these are the two orders in the market. Which one will be executed if it's a price priority? Obviously, this one will get executed because the seller will accept an order which is at a higher price. Seller wants to profit. If seller wants to profit, that means buyer has to pay premium. So here the same thing is written over here. Buy orders with higher prices will get executed first. And conversely, sell orders with lower price will get executed first. So this is the price priority. Second is a time priority. If orders arrive at the same price level, those entered earlier will receive priority. That means I put order of 106 at the rate 10,000 at 11 a.m. and then I put 106 at the rate 20,000 at 11:02 a.m. This will get executed first. Execution process. When a new order arrives, the system matches it against the best available counter orders following the price time priority. This is simple. Like I purchased 10,000 shares at the rate 400 price. The algorithm will look at the seller order book and it will try to match the quantity and the price in the best available manner so that the entire buy order gets executed. So this is the price time priority algorithm. Then we have the order book depth and structure. The order book, what is order book? Buyer, seller, buyer quantity at the rate price, seller quantity at the rate price. Like this, lot of sellers will be there. Like this, lot of buyers will be there. Together, it is known as the order book. The order book is central repository of all active orders. What is bid side? We explained. Bid means buy, ask means sell. The difference between bid and sell is the spread. Say suppose I want to buy at 101.40. The seller is not ready to sell between 100 and below 102. The spread is 0.6 because 102 minus 101.4 is 0.6. It is very simple. Buy, bid means buy, ask means sell, bid or spread is a difference. So it is self-explanatory, contains all active buy orders, contains all active sell orders. It is a difference between the best bid and the best ask. A narrow spread means high liquidity, wider spread means low liquidity. Suppose now this spread is 0.6 as of now, and in the afternoon this spread goes to 0.9. That means the buyer and seller are not agreeing to a price. That's why the spread has increased. When the spread increases, the market becomes unfavorable. because buyers and seller are not agreeing to a common price. When the spread reduces, the markets become favorable and liquid. Now we'll quickly see what is the market data dissemination. Dissemination means distribution of information. Distribution of information. So markets always provide real-time quotes. Whenever you see the bolt or whenever you see the trading desk, it's all real time. It also has a market depth. Market depth means order book. We saw in the last slide, buyer and seller, whatever is the quantity and order price. Trade information, whatever trades are executed, like you have bought 101.04 and you have bought 400 quantity at 11:02 a.m. All this information is provided back to the buyer, seller and the CCP. And market statistics, that means what was the opening of the market, what is the high point of the market, what is the closing of the market, what is the midpoint of the market. All these statistics are generated by the exchange to provide the market data information. Now this is very important, risk management and order routing. Routing means sending it to multiple entities. We'll see first exchange level controls. Overall market-wide limits and circuit breakers to maintain orderly trading. So this is the first level. You must have heard that stocks will have limits like 10%, 20%, some have even 5% as the circuit limit. So these limits are defined by the exchange. Then there is member level control. Whenever you see member, member means broker. So each broker will have some control or some limit based on their net worth. A large broker will have a large limit because he has the capacity to pay. A small broker will have low limit. So based on the member size, the limits are defined. The client level controls, obviously individuals will have lower limit. They don't have much capital. But if it's a bank or if it's a corporate, it will have higher limit based on the risk profile. The bank can pay back easily millions of dollars, but for an individuals, the limit will be low because he's an individual. It has limited net worth capacity. And then the order level validation, real-time checks on order for price reasonability. It should not happen that the market is at 101.04 and you're trying to inject multiple orders at 99, 100, 78 and all those things, because these orders are not going to get executed, right? This might still get executed. This might also get executed, but this order is never going to get executed because it's unlikely that the price will fall by 25-30% in the current day. So mostly these orders, there are some exchange platforms, these orders are automatically hidden from the order book. This is also known as, phishing orders, also known as phishing orders. That is a separate topic. We can touch base upon that one, maybe in the subsequent slide. Then from the order routing, we go to the pre-trade risk. As the word says, see, here is an order. When you place it, it goes through the risk management engine. And once it is confirmed, it becomes a trade. So order does not equal to trade. Order means you're ordering. Once the check is done, then only the trade will get executed. The first stage is margin verification. Exchange will verify the margin because a buyer, if he is saying that he's going to buy $1 million of bonds, and the seller is saying that he's ready to sell $1 million bond futures, exchange will check whether both of these guys are actually having the margin money to support this transaction. Then is a position limit check. If the order is executed, it should not exceed the regulatory and exchange imposed position limit. Suppose there is a regulatory limit that you cannot have more than 5% of overall market depth. Suppose the market depth is 100 million. So 5% of that will be 5 million. So any order which is above 5 million, the exchange will not allow. Why? Because this limit will trigger. So these kind of limits are also checked. Then the price reasonability, ensure order price falls within the acceptable bands. This prevents erroneous orders. As I explained, suppose the current price is 101.04 and I try to place an order of 78. Most platforms will try to negate this order because this is a phishing order or this is an incorrect order. The next is the order value limits. It checks that the total value of the order does not exceed the predefined limits set for the exchange, for the member. Suppose a broker has a net worth of $1 billion and the exchange says based on your net worth, you can have 2x of exposure. That means you can have $2 billion of exposure. Now, because of some order, this exposure is going to 2.2 billion. The exchange will stop it. It will say it is exceeding the trading member limit. It is exceeding the trading member limit and hence you cannot proceed with this order. Next that we will see is basically what is a position limit framework. This is similar to the pre-deal or pre-trade checks and limits. Regulatory position limits, as I mentioned, there could be regulatory limits like single broker exposure, single issuer exposure, something like that. So there are regulatory reports which are regulatory limits that are laid down by SEBI and RBI. Apart from regulatory limits, there could be individual client level limit, trading member. Trading member means broker and beneficiary or owner level. This is again also client level only. Now what happens is when you place the order, before the trade is executed, execution of trade, there is a pre-deal check. Pre-deal check means checking the deal or checking the order against these limits. If the order passes these limits, then the trade is executed. If the order fails this limit, then the trade is stopped at this level only. The order is stopped at this level only. These are regulatory limits. Then there are exchange limits also. Exchange may impose additional position limits beyond the regulatory limits to ensure orderly markets and prevent concentration of positions that could impact market liquidity. Market liquidity and depth, as I mentioned, example, the total bond market suppose is $100 million and there is a limit of 5% that an individual cannot hold more than 5% of the total market depth. Otherwise, what will happen? This individual might become stronger and he might create illiquidity in the market. Historical volatility patterns, that means exchange can put circuits. You are aware of circuits, upper and lower circuits. Participant category and risk profile, that means if an individual is a risk averse investor. Risk averse means he is not by the social profile or by the risk profile, he is not a risk taking investor. Certain products might not be applicable for him and those limits are in place. Next is the margin requirements and monitoring. Margin means additional upfront money. See, suppose I want to buy 100 million of bonds. So because I'm buying a futures of 100 million, I don't need to post 100 million. I need to post only 21 million, 21%, say 21 million to take an exposure of 100 million. That's why futures are leverage contracts. For this is the initial margin, initial or upfront margin, because that is paid at the start, required at the time of taking the position, calculated to cover potential losses. Span margin is one of the techniques which is used in equity trading. Based on the span margin, the calculation is done. Then there is mark to market margin. Suppose you had bought 100 million futures contract over here at say 104 and now the market prices have gone to 102. So you are in $2 mark to market loss. Now this 21% that you had paid earlier was to cover the initial position of 100 million. But here additional 2 million loss is there. So you will have to post additional margin because now you are in loss. Suppose this 104 had become 106. Then you don't need to post any margin. Why? Because you are in profit. You will post the margin only when you are in loss, when the MTM mark to market. This is known as MTM, mark to market. Mark to market, you are in loss, you need to put the additional margin, which is mark to market margin. And there is something called as ELM, extreme loss margin. Suppose there is a budget announcement or there is a war announcement which has happened. What can happen to this 104 that we had bought? It can go to 108, it can go to 110. On the lower side, it can go to 100, it can go to 95. This will become a very highly volatile market. Now, during the volatile market, extreme loss margin, which is the possibility that a bond or a futures contract might show extreme margin, extreme movement, is high because the volatility is high, right? So additional margin is collected during the periods of high volatility because the chances of the bond market to go on either side is higher. That's why apart from the initial margin, which is IM, then there is mark to market margin, MTM, and additional margin, that is extreme loss margin, is added to the position. So these are basically risk management techniques that are deployed by the exchange so that at any point of time there is no default by the purchaser or the seller of the futures contract. Again, risk monitoring, but look at the keyword real time. Real time means because the orders are being placed in real time in the market by the buyers and sellers. That means the risk management has to be quick because the market is moving. If it has to be quick, it has to be near real time. So which requires continuous surveillance of the market. So there are a lot of softwares which are deployed which do continuous surveillance of the market and the prices. Margin shortfall alerts. Now, even suppose if you have done any FNO trade in your own account, a lot of time your broker will say margin alert. Why this margin alert comes? As I explained yesterday in the previous slide, you bought at 104, the current price is 101. So you are in a $3 loss. This $3 loss is over and above the initial position. So that means you are shortfall of your margin. Hence the broker will message you or he will call you to put additional collateral or cash. Concentration monitoring. This also basically applies. Suppose a single security, say XYZ bond futures, is being traded a lot and there are few players who are holding this security. So the exchange or the intermediaries will always keep on tracking the concentration monitoring of the trades. Correlation analysis, assessment of relationship between different positions and contracts to identify portfolio level risk and potential contagion effects. Suppose I have a government of India bond, then I have state government bond, and then I have corporate bonds and something like this. I have a 10 bond portfolio. Now this government of India bond is less risky. So I'll just mark it in amber, less risky. And the corporate bond is more risky. That means the correlation in both of them is low, because if the market becomes risky, this will become very risky, but this will become very beneficial because this is government backed. So the correlation between a corporate bond and a government bond is low. What if this government bond portfolio is not there and I have a corporate bond AA rated, AAA rated, double B rated, something like that? Now the correlation is high because all of them are corporate bonds. So if there is any stress in the market, this portfolio will have more loss because there is no government bond which are less risky to save it from the loss margins. That is why correlation is very important of the overall portfolio. And the last is the volatility tracking. As I mentioned, circuit limits. When the volatility increases, the chances of a underlying security to cross 5%, 10%, 20% in a single day increases because the volatility is high. That's why a lot of circuit limits are applied by the exchanges. So we have finally come to the topic, which is price limit circuit filters. First one is the price band. Orders outside a specified percentage band are rejected. Suppose market started at 104, now it's reached 106. The exchange will say that we will not accept any order that is above 107. Why? Because this movement is high. This is a hypothetical example. But this is just an example to explain you that where will a price band limit come. So a price band limit, exchange will say that any order above 107 will be directly rejected because it wants to protect the volatility of the market. Trading halt. If the price moves beyond a wider threshold, trading is halted for a cooling off period. This allows market owner to reassess positions and prevents panic driven trading. Now what will happen? Let's say you remember that in the 2008 crisis, there was a free fall in the stock market because stock of this company, say a company a company ABC, the stock is falling down and the stock has gone down by 40%. And these companies are also having bonds in the bond market, and the bond market are also falling now. They've started falling now. But actually, there is no problem in this company. Actually, there is no problem in the company because the market is falling down. All the stocks are taking a beating and all the bonds are taking a beating because there is panic in the market. Everyone wants to sell and get out. In that scenario, the exchanges will put a circuit, say 5%, 10%, 20%. If the security moves into 5%, 10%, or 20%, they will halt the trading for certain time so that people can reassess their position and they do not panic. Because actually there is no problem with the market. It's only because the overall global market is seeing a sell-off. A lot of people will, try to sell off and get out of the positions. Market closure. In extreme cases, the price movement exceeds, the market is closed. Recently, you must have seen that in the commodities market, the silver went up, so did the gold. And in certain exchanges across the globe, the silver shortage was so much that they had to close the trading venues. They had to close the exchanges because there was a shortage of silver to deliver. In extreme cases, the exchange might close the trading venue itself. They will say today there will be no trading in the exchange. So this is extreme cases. How the circuit filter is implemented. Static price bands, as I explained. If it started at 104, current price is 107. They will say we'll accept orders only in the range of 104 to 107. Anything above 107 will be rejected. Advantage is it is simple and transparent to understand and predictable trading boundaries because you have a range. It might not adapt to intraday volatility and create artificial price ceiling and floor. Suppose a bond is really good and there is a genuine demand of it above 107. But since there is a limit of 107 applied by the exchange, this bond will not be traded. What will happen? This bond will not be traded. This will create an artificial ceiling. This will create an artificial ceiling because 107 is not the actual price. It could be 109 also. But because there is a circuit limit in place, there is an artificial ceiling on the bond. Then there is dynamic price band. So this was static 104 to 107. They adjust based on the real-time market conditions and trading patterns. These bands widen or narrow automatically to accommodate legitimate price discovery. Now what happens? Suppose again, same example 104 to 107. Now, but at 107, the exchange says that okay, 5% above 107 with some limitations and the volatility index not going below 5%. These are some of the limits. If all the conditions are okay, you can adapt to the market requirement and create a circuit of 107 plus 5%. Now this becomes dynamic because it is 107 plus 5% and it can also go further because there is no static price band. It is saying that adjust the price based on real-time market conditions and automatically widen and narrow the bands. That means if there is a lot of volatility, 104 to 107 will become the band. If the volatility is low, it will become 104 to 109 because now the volatility is low. So there could be more players who want to actually buy and sell the bonds and there is no panic in the market. So this is a dynamic price band. Now let's see the actual circuit filter implementation in Government of India bond futures, 91-day treasury bills, overnight MIBOR futures and corporate bond index. In the Government of India bond futures, the circuit limit is plus 3% and minus 3%. So this is the circuit limit for government bonds. A trade in any contract is executed at the highest or lowest price of this band. Exchange may expand the price band for contract by 0.5% after 30 minutes of cool off period. So the actual limit is plus 3% and minus 3%. And suppose it reaches, then there is a 30-minute cool off period. Then it can go further 0.5% 2 times in a day. That is 1%. So what is the outer limit? 3 plus 1, 4% on the upside, minus 3 minus 1, minus 4% on the downside. This is the total limit for the Government of India bond futures. The question will be in exam which will be asking what is the price band for Government of India bond futures. Similarly, what is the price band for 91-day till T-bill futures? That is plus 1 and minus 1. Overnight MIBOR futures 5% plus and minus. Corporate bond 5% of the previous closing. Again 30 minutes of cool off period. And after the cool off period, it can go ahead by 0.5% 2 times in a day. That is another 1%. So based on the instrument, the circuit limits are different. Again, repeating Government of India bond futures plus 3 minus 3%. And after 30 minutes of cool off period, it can go ahead of more 0.5% on either side. And that too 2 times in a day. 91 T-bill straight away plus 1 minus 1. Overnight MIBOR plus and minus 5%. And corporate bond futures 5% with a limitation of 0.5% 2 times in a day. So this is important from an exam perspective. What is the total cost structure? Suppose I have applied, placed the order at 104 for some futures. When I get the contract note, I get the price as say 105.10. But I had applied at 104. My order was placed at 104. So what is this 105.1? So 105.1 and 104 has a 1.10 difference. This 1.10 is basically the trading charges and fees like STT in equity. So what are those charges? 0.01% is the transaction charges for the exchanges. 0.002% is for the CCP, the clearing party. 0.01% is the SEBI turnover fees. And 18% is the GST. So these charges are applied over and above 104 and you get a final price, say example 105.1, which is your fee adjusted price. Fee adjusted price. Quite simple. In case you have done equity trading, you will be aware of these charges. And what are the different brokerage models that the broker charge? What are the percentage based brokerage? They can say that typically for a 1 million contract, we'll charge 0.1%. For a 5 million contract, we might charge 0.05% or 0.02%. This could be a percentage based charge. Then it would be a per contract. I can say that the broker can say that for one lot, I will charge you 20 rupees, like what discount brokers in India are doing, right? For one lot, they will charge 20 rupees. So if I buy 5 lots, I will be charged 100 rupees. If I buy 100 lots, I will be charged 2000 rupees. So this is percentage based. This is per contract based. Then there is a flat fee model. It will say that up to $1 million of transaction, I will charge $5,000. Flat fee. And anything above $1 million is a flat $10,000. So these are the different types of brokerage models that the brokers follow in the world. And what is the impact of trading cost on strategy? Now again, let us take the example. I bought it at 104, but when I got the contract note, it was at 105.10. That 1.10 is trading cost and fees. High frequency strategies are most sensitive to transaction costs as they execute numerous trades. Even small percentage trade costs can erode the profits. Now what is HFT? A manual order placement by a dealer. A dealer might place 5 orders in 1 minute, or he might place say 50 orders in the entire day, right? Because he is a human and he will see the market and he will analyze and he will place the order. But suppose it's a machine which is executing high frequency trades, which is also known as algo trading. Now this algo trading will continuously search for patterns to make profit. So it will continuously buy and sell. But for every buy and sell, there are transaction costs which are involved. And because of this continuous buying and selling, their overall profit might go down because a lot of charges and fees will come into picture. So that's what they are explaining. Because for HFT, the cost impact is high. Swing trading, 25%. Swing trading means you buy now and you sell maybe one day later or once your price has reached. So this is also buying and selling, but lesser frequency than the HFT. This is not every minute or every 5 minutes that you're buying and selling. This is basically swing trading. You might want to buy and sell it at the end of the day or something like that, right? And then finally on the position, now this has the least impact. Why? Because this is less buy and sell. Generally, you buy a bond and then you sit on it for 6 months, maybe before selling it in the market. So the buy and sell frequency is low. That's why my charges are low. So now what is order routing and execution quality? Now what is DMA? DMA is direct market access. Say institutional traders like big banks like HDFC, SBI and other guys, right? They want direct market access. Why? Because they want minimal latency, that is information delay. They don't want any information delay. They want the direct market access. Direct market access is those screens that you see which the brokers are using, right, to trade on the market. So these institutional guys will always look for a direct market access where they can directly place with the exchange. So in the direct market access, it's simply dealer to the exchange. So there is no one in between. But people like me and you, we have brokerage account, let's say with Zerodha or with Upstocks, with ICICI, Angel. We have these brokers who in turn are taking the data from exchange and then providing us. So there will be a slight delay in the data because here the exchange is directly providing to the dealer in the direct market access. Here the exchange is first providing to the broker and then the broker is sending this data out to the dealer. So there will be slight latency in the data. Algorithmic routing, orders executed using sophisticated algorithms that optimize execution based on market conditions. Now let's see that you are a high frequency trader, but you don't want to sit in front of the screen and you don't want to scan the market manually. You can write an algo, say between 9:15 to 9:30 when the volume is highest, execute all my buy trades. And then you can say when the volume is lowest, avoid any trading. These kind of rules can be placed in the system, and the system basically on that rules, it will automatically place the order and route the order to the different intermediaries. How now execution quality, again focus on the word quality. Quality means minimum impact. Whenever I am trading, the price should not have a large impact on the market. So first parameter is fill rate. Suppose I have placed an order. Higher fill rates indicate higher execution quality and sufficient market liquidity. Suppose I wanted to buy 100 million of bonds, but I'm able to buy only 60 million of bonds because there are no sellers in the market at my price. That means the market is not efficient. If I place $100 million and in 5 minutes all $100 million is absorbed by the market, that means the market is liquid and efficient. Then is the price improvement. Difference between execution price and quoted price at order submission. Suppose I place the order at 104 in the market, and before placing the order, I had planned that I can go up till 104.5. That was in my mind that up to 104.5 is okay. So I placed the order at 104, but when the order arrives in the exchange, the price is 104.70, which is also okay, which is near this. But suppose if the price goes to 105, that means the market has hidden liquidity because positive price improvement indicates better than expected execution. If 104 becomes 105, that means there are no sellers at 104. The next seller is at 105, which is a loss for me because I plan to buy at 104, but the seller is at 105. That means the market is less liquid, or by the time my order reached the exchange, the price has already moved by 1 rupee. By the time my order reached the exchange, so my order was placed in my OMS, and here is the exchange. So it is actually split seconds, but in that split second also the rates can change. So I placed at 104, but when it arrived in the market, the price moved to 105. That means there is hidden liquidity in the market. It could be good liquidity or bad liquidity. There could be fake orders, there could be fake order books. So there are a lot of spoofing also of order books that happen. That's a separate topic that we'll see. But for now, just understand that price improvement means if you purchased at 104 and it executed at 105, that is a poor liquidity. But if you purchase at 104 and it actually got executed at 104, that means it's a better liquidity, keeping all other things constant, right? Then market impact. Suppose you want to buy $1 billion of bonds. That means you are trying to buy 10% of the market, say example, market depth. It's a very big order. If someone is placing such a big order, it will have a high price movement. Suppose I placed it at 104 and because of my purchase, the price itself has gone to 108, which is not good for me because I wanted to buy at 104. So what happens? I will apply certain algorithms which will break the order of $1 billion into $100 million and 10 orders. That equals to 1 billion. So all these 10 orders will be slowly executed, not impacting the market price, so that there is minimum market impact of my large order. So the three things are fill rate, which is how much the orders are getting executed, price improvement, what is the delay of the order arrival, how much price movement is happening, and what is the market impact in case I want to place a larger deal in the market. Then how the trading session is structured. So pre-opening session, I'll explain you in terms of the equity market. Pre-opening, we know that it is between 9 to 9:15. This is a pre-opening session where the order collection phase starts, but it is not matched. You can place the order, but there is no execution which is happening, only price discovery happens. Then the opening session, say example 9:15, here the call auction market starts. Fair opening price that reflects overnight information and order flow. What is overnight information? Suppose there is some attack on, or there's a war between two countries and it happened previous evening. The previous evening market was closed, and suppose the bond price closed at 104. In the morning, the bond price might open at say 105. Suppose it's a government bond, it becomes much more secure, so it becomes much more valuable. Or it might open at 109. Why? Because more people want to buy safer instruments. So overnight, the price has increased from 104 to 109, and in the pre-opening session you will see that the orders are being placed at 109. This is the price discovery. Then this is continuous trading. Say for in equity parlance it will be 9:15 to 3:30, and then the closing session, say example 3:30 to 3:45, wherein the call auction, short trades and other things are happening. So this is basically the sessions in which the trading is divided into. Each session has its own value. Pre-opening session is for price discovery. Opening session is to actually execute the trades on opening based on the last overnight information. Continuous trading is the overall market opening times, and closing session is where any short positions or any auction market trades are unwinded. Market making and liquidity provision. Market making means someone who has high influence of impacting the market movement. Market maker means high influence of making a trade happen. Suppose SBI wants to sell $5 million of government bonds. Is it easy or difficult for SBI? It is very easy because they have a lot of inventory, they have a lot of network. It can actually make a market for itself. But suppose a small institute wants to sell a $5 million of government bonds, he might have to wait for the market to be favorable to slowly exit his position, right? So that's why market makers plays a crucial role in ensuring continuous liquidity and tight bid-ask spreads. What are the market maker obligations? Maintain continuously two-way quotes within specified spreads and minimum quantities. Provide bid-ask spreads continuously and simultaneously. Maintain quotes within the spread limits. Ensure minimum quote size and minimum market presence obligations. Meet minimum market presence obligations. That means if a market maker likes, let's say like SBI, who has a large inventory of government bonds, say suppose they have $5 billion of government bonds, their job is to continuously provide liquidity to the market, either on the buy side or on the sell side, right? Because they are the market makers. What are the benefits to the market makers? They receive incentives and concessions in exchange for liquidity provision. This helps them to offset risk associated with continuous market presence. And in certain situations, they are also given priority. You can read this. This is self-explanatory. These you can just pause the slide over here and read it. This is more of a theoretical thing and knowledge to gather. Then what is the impact on market quality? Market makers significantly improve the trading conditions. Why they improve? Because they have such a large inventory and such a large market information and impact that they can continuously provide selling and purchase support. So they improve the overall liquidity in the market, which leads to tighter bid-ask spreads. What are bid-ask spreads? Suppose a buyer is buying at 104 and the seller is selling at 104.10. This is a tight because the difference is less, so it's a good market. But suppose I want to buy at 104 and the seller is not there at 104, he's at 107. That means it's a wide spread. That is a poor market. So because the market maker is there in the market, that's why the bid-ask spreads always remain tighter because they continuously supply the purchase and sale inventory. Finally, trade reporting and transparency. Real-time reporting is required. Why? Because these are real-time trades. You're placing the order and immediately you're getting the confirmation. So you need a transparent reporting. You need to report it back in a transparent manner. And whenever the orders are also coming back, they are coming with the timestamp, like 11:02, 57 milliseconds, the order was placed. So it will come with a timestamp and a date stamp. Trade details, comprehensive information including contract price, quantity, timestamp, as I mentioned, trade identifier. Detailed report enables accurate position tracking and settlement processing. Trade details means who was the counterparty, who was the broker, what amount I purchased the bond for, what time, whether it's a buy or a sell, what yield I got the bond at. Example. Historical data, complete trade history is maintained for regulatory compliance. Why? Because say suppose I purchased at 104 and I got the contract note at 108. I can go to the broker and file a case against him saying that I placed the order at 104. I have a proof of my placement at 104, but you have executed at 108. If the broker is not maintaining the historical data, he might not be able to defend himself. So that is why they have to maintain historical data. In certain regions, there is 7 years of data is expected to be kept mandatory, so that at any point of time there is a dispute, the historical data can be used. Now, market surveillance and monitoring. This is done by regulators, RBI, SEBI, and exchanges. Pattern detection, investigation process, alert generation, preventive measures. These are all self-explanatory, but let's go through it. Pattern detection means it will identify potential market manipulation. If you see a certain bond future contract continuously being purchased by the same set of entities, that means they are doing a circular trading. If a security is being purchased or a bond futures is being purchased by the same entity, or it is being purchased in a similar quantity on day-to-day basis, the systems will identify a pattern and they will alert. A detailed examination of flagged activities, including review of order patterns, what I explained, communication records and participant relationships. There could be a broker and its subsidiary company might be the institutional investor. Say example, ABC is the broker and ABC also has a sister concern which is ABC Corporate. So there's a material relation between them, and in this investigation process they see whether these parties are related to each other or not. And then the alerts are generated based on the patterns, and limits and proactive controls are applied so that these patterns get detected earlier in the market. And what is the technology infrastructure which is required? One is required as the matching engine. Why? Because buyers and sellers are continuously putting the orders. There has to be a matching engine which actually matches this order, and it should work in peak loads. Say example, we saw that during the budget day in the year 2025, a lot of exchanges, they could not process the order because so many orders were coming in, the system went down, right? So especially in the mutual fund section we have seen that, or in certain other products also. So what happens is, because this matching engine requires high performance, the trading infrastructure should have high performance matching engine. Connectivity infrastructure, obviously this is no brainer because all transactions are happening through online channels. So good internet uh, connection, high speed internet, high speed network, all these things are required. And what is disaster recovery? Disaster recovery is, suppose the exchange is located in Mumbai. The exchange is located in Mumbai and there is an earthquake in Mumbai. So obviously this exchange cannot, they cannot open today, maybe, or there's a fire in the exchange, something like that, right? So what will happen? This exchange in Bombay will have a disaster recovery side, say example in Chennai. And immediately all orders are routed to Chennai and the Chennai office gets activated. So the people in Chennai, they will get activated and they will start taking orders from other locations also. So this is called a disaster recovery. If there is any disaster, how do you continue the operations? And these are online trading, so they require cyber security, unauthorized access, denial of service, data manipulation, and malware viruses. So these are the threats that are there, because we have seen a lot of hackers, they try to lock the system and then they ask for ransom. It's also known as ransomware. So if you Google about this, a lot of Indian companies have also faced these kind of issues wherein hackers have locked their system and they have asked for ransom. So these are the threats and these are the measures. Multi-factor authentication, that means you get an OTP on your mobile as well as your email. So it's multi-factor. So it's very difficult to hack. High-end encryption detection, that means good antivirus softwares. And regular audits, basically whoever is using the softwares and hardwares, what are the versions, is it patch controlled, is it protected, and all those things. We have seen this regulatory compliance in trading, registration and authorization. Trading members means brokers. So brokers must obtain necessary registration and approval from regulatory authorities. It should not happen that a broker who has only equity license start offering bond trading also. This cannot happen, right? Or he might start bond futures also. So a proper registration authorization has to happen. You should always deal with authorized brokers. And ongoing compliance, continuous adherence to regulatory requirements. So reporting back to the regulators, what are the breaches, what are the issues, what is the margin shortfalls, what are the defaults that are happening. And these members are obligated to report it on timely basis. Some reports are monthly, some are 6 monthly, some are yearly, some are on daily basis. So these reportings are required so that the market remains sane and there is no frauds and there are no issues in the market. And finally, client protection. This is the most important. Because the client is trusting the broker with its money, right? This is the client. Here is the broker. And he is responsible. Broker is responsible to execute the market and they do everything. The client is paying the money and getting the trade done in exchange. So client protection becomes a very, very important part for the broker, and the broker has to ensure that the client is protected, client's money, client's positions are protected, and it is done in a proper manner. It should not happen that the client has paid, say, $10 million or $100 million, and the broker has kept it in his own account. No, the broker cannot keep it in his own account. It has to go to a dedicated client account. So these are some of the things that are required for regulatory compliance. Then what are the best practices? Risk management. Implement comprehensive risk management. Obviously, we have seen this. We have seen this order, trade. Once you place the order, it goes through the risk engine. If there are any issues, the order is rejected. If it is not, the order is processed and the trade, it comes back to the dealer. Use appropriate order types and execution strategy based on the market conditions and trading objectives. Someone like an institutional investor he does not want frequent trading. So his objective is to buy and hold. So he should not be given certain strategies which is not as per his objective. The broker should not misguide them. Technology preparedness. Obviously, we saw in the last slide, technology is very important. So you need internet connections, good bandwidth, you need disaster recovery in place, you need cyber protection and all those things. And continuous learning, as and when the markets are evolving, new threats are coming in the market, new issues, new types of frauds are coming in the market, payment frauds are happening. So members should be aware of what are the new threats and new problems in the market. Now, what are the common trading errors and how do you prevent it? Fat finger errors. Now, suppose I wanted to place an order of this amount, but since by mistake I placed one more zero over here. By mistake I placed one more zero. These type of errors are known as fat finger errors. Incorrect order due to typological mistakes, such as wrong quantity of price. Prevention includes pre-trade validation. But if I have a risk engine in between, and suppose I wanted to place for 10 million and I placed by mistake for 100 million, this risk engine will catch it. It will tell that this is outside your limit. Do you want to proceed or not, right? Duplicate orders, unintentional submission of same order. Suppose you press the enter key twice. So the system should be smart enough to understand that this is a duplicate order. Wrong contract selection. Suppose you wanted to buy July contract, but you purchased June contract and June contract is ending in 2 days. So system should have validations to explain you or even ask you for a confirmation before placing the order. So these are some types of errors and prevention methodologies. What are the expected future developments in trading technology? Artificial intelligence. This is a buzzword. We all are using this. We know that AI is progressing very fast and there are AI enabled trading mechanisms which are already in the market. Blockchain integration. This becomes important because here you don't require humans to take care of the chain. The blockchain itself will keep a copy of who was the buyer, who was the seller, who is the next buyer, who is the seller, and how much they are holding, right? These are blockchains. And cloud computing, this is required in Indian market because this is faster and scalable. India is the biggest derivatives market for equity, not for the bond as such, but for the equity, India is the largest derivative market. So it's important that the cloud infrastructure is in place, and in future, because the more and more people and more and participants will come in the market, so the scale will get higher and higher. Finally, what are the key takeaways from this chapter? First is you require a comprehensive infrastructure like exchange trading systems, matching engine, risk engine, cyber security protection, XYZ, whatever we saw in the technology part. Multi-layered risk controls. What is multi-layered? One is OMS level at the order management system, then is at the client level, then is at the broker level, and then at the exchange level. So every entity involved over here should have a risk management system. Transparency and surveillance. Transparency is guaranteed at least in the Indian market because your exchange provides the date and timestamp along with other order details. Continuous technology innovation. This is required because today more and more people are joining. So the scale is increasing day by day and the peak volumes are also increasing. And participant responsibility. Trading participant must understand system mechanics, comply with regulations, and implement proper risk management, follow best practices. So this is self-explanatory in that sense that all the members should follow the rules and regulations that are laid down by the exchange and the regulators.
So yeah, let's see the responses. So first one, most of you guys have got it correct. It is more or less self-explanatory. An order can be placed through any of the medium. The second one is a buy or a sell order which is lying unmatched in the order book is known as a passive order because it is not yet executed, right? So it is not an active order, it's a passive order. The third one is basically a market order is classified as price related condition. Why? Because a day order will be based on the day validity and IOC is immediate or cancel irrespective of the price. So the only order which is defined as a price related one is the market order. Fourth one, most of you guys have got it correct. Due to the denial of matched orders, an operational risk can occur. It's not a market risk, it's not a regulatory risk, it's an operational risk. The last one is where you must have selected the answer B, but the correct answer is C, because for MIBOR futures, the range is 25 basis points, right? So for 25 basis points below 5 is 4.75 and 25 basis points above 5 is 5.25. So just remember for the exam, you have to remember that what is the MIBOR range, what is the government security range, what is the corporate bond range. With that, we'll close this session for today. Thank you for joining, guys.